Hello, this is Mitch Goldberg. You're watching Be the Boss of Your Money, the place that you go to learn the real deal about personal finance, which includes so many things like financial planning, estate planning, investing tips, you name it, we're going to cover it here. And sometimes something a little bit of a mystery pops up. And what's the mystery today? The mystery is called GameStop. What happened with GameStop? Why did the stock rally 150% this morning, only to get cut in half by the end of the day? What's going on with stocks like this? Is it an indication of massive froth in the stock market? Does it mean that, hey, maybe things are getting a little bit too carried away? Maybe this reminds us too much of the 1999 tech wreck that after the NASDAQ popped, took about 15 years to recover. Could investors wait that long? Could you afford to be in a bubble? We won't know if we're in a bubble until after the fact. We have a few other things to talk about. So we're going to go through a usual quick market date with perspective. We're going to talk about GameStop. If you're watching this in the live stream, I would love for you to ask me questions about any of the things, the topics that we're talking about today. Today is going to focus on investing and a new term, well, it might be a new term to you, called short squeeze. If you're watching this in the replay, I'd like to welcome you as well. Certainly feel comfortable. Feel free. Hit me up with those questions. Words of wisdom, words of encouragement, they're always appreciated. So let's roll the quick intro, and then we are going to get into this. Thank you so much for joining me. Your time is very valuable. I know it is. It's very valuable, and I do my best to give you something worthwhile to think about, to learn, maybe something that could even change the trajectory of your life. That's how important this show is, and I do want to bring something of value to you every day. So thank you so much for joining me. Your time is very, very valuable, and I just want to thank you for spending some of it with me. We've got a few things to talk about today. First of all, there was GameStop. Last week, 2 weeks ago, it was all about Bitcoin. Before that, it was all about Tesla. And I couldn't blame you if you feel like you're missing on these gigantic runs and you're thinking, I don't care if GameStop is a company that is not even relevant in the marketplace anymore. The low on it is $2 and change. The stock at 150 today. And then I could say, but their business isn't relevant. Their financials are terrible. It's questionable if that company is going to be able to survive. And you'll say, maybe, I don't care. So it really depends on how much you want to speculate and what your time horizon is and your risk tolerance. That's really what really counts. So let's take a quick look. We'll do the share screen. We're going to go through some updates. I'd like to welcome, by the way, Jay Spindell. Nice to see you, Jay. I really appreciate you joining us. We've got a few people out there watching. Folks, let me know where you're watching from. You in Manhattan? You in Jersey? You in Long Island? You in California? People watch this show from, believe it or not, all around the world. And I would love to know where you're tuning in from. And if you have any words of encouragement, you want to talk about the topics today, especially the phrase short squeeze, then you are I'd love to hear what you have to say about it. Okay. I'd love to hear your thoughts or read your thoughts. Put the comments up on the screen and it'll make the show a lot more fun. I think to me that's the best part. Let's do a quick share screen. Okay. And if there are other topics that you want me to discuss, I definitely want to hear about them because the things that you have questions about, the financial topics, the personal finance topics that you want to know more about really is what my content should be all about. So let's just take a quick view, quick gander, short squeeze. Let's take a look at the share screen. I love working the controls and I'm doing it all. I love doing this. I've got to tell you, I love the live stream. So the Dow was off a measly 36, 37 points. It was down well over 150 at one point today, and it started to look like it was could be a pretty nasty day. But no matter how you slice it, the NASDAQ just held up all day, and those super large FANG M stocks, those mega cap tech stocks, which really started to recover last week. They had been in the doghouse for a little while industrial stocks went up. But the big tech stocks really powered higher last week, especially Netflix, up about 18% in one day. That is a massive jump for a company of Netflix's size. The S&P was up modestly today. NASDAQ up almost about 0.7%. The Russell 2000 off a drop, and the VIX was up a little bit. But overall, I would say this was about as ho-hum of a day as you'll ever find. Just quiet day until you look underneath the hood at individual stock components. Let's move on a little bit. The FANG stocks, Apple was up almost $4 today, looking to assault its previous year high. Microsoft moving higher. These stocks, by the way, Facebook, they all report this week. So it's going to get very busy with earnings reports starting tomorrow. Apple reports on Wednesday after the close. Facebook up, Google up. Look at Facebook. Facebook is basically back to where it was about a month ago, when the Department of Justice and other states said they're going to start suing and investigating Facebook about monopoly status, maybe breaking it up. And I'm actually thinking, well, if they break it up, maybe the sum of the parts are worth more than the whole. But the stock has recovered that anyway. And as I've said to you in the past, I'm not selling any Facebook because of politics or investigations from the Department of Justice or states. These things come and go like the wind. I'm going by the fundamentals, and Facebook and Google have something like 90% of the advertising market on the internet. And as big as the internet is, you can realize how big these companies are. Amazon is a very big player too in advertising. Google up, Amazon, Netflix. Okay, so Netflix was up huge last week. So the fact that it was off a little bit today is not really a big deal. Reopening stocks, aside from Cinemark Holdings up a little bit, they've gotten a big cash infusion. The stock was up a lot more earlier in the day, but Cinemark got a cash infusion. They were able to sell. I think they were able to sell some stock. The point is, bankruptcy for them is for now taken off the table, and it looks like they'll have enough money to get through the rest of the pandemic while vaccines are starting to reach to get injected into people's arms, and they could survive. But American Airlines, Norwegian, even Planet Fitness, which has been a great performer, is down. Marriott, which has been a great performer, starting to come back. Delta, Southwest Airlines, UAL, Royal Caribbean, Carnival. It's been a really tough day for the reopening stocks. And what I said last week on Thursday, I said, the reopening trade is something we got excited about, and it looks like maybe it's gone just for now a little too far. And what the bottom line, what I've been saying is, don't just own reopening stocks or economically sensitive stocks and sell all of your and sell all of your stay-at-home work from home stocks. You need both, okay? Because this is going to be a back and forth view of what's going on. Back and forth trade between economically sensitive and work from home stocks. That I don't think that back and forth pattern is going to stop. Let's take a look at the sectors today. Utilities, best performing group of the day. Some of these utilities are getting a lift because some of them are viewed as ESG stocks, electrification stocks, solar power, etc. So the utility industry has really transformed itself pretty rapidly over the last 10 years. And it's looking like a much growthier sector. It's not just about, stocks for widows and orphans that have dividends and steady cash flow. The stocks never go up, but they never go down, but they just pay a dividend, kind of like a bond replacement. I don't really look at utilities like that anymore, and I don't think you should either. Consumer staples were up, but the same stocks that led the way during the pandemic went up, and the stocks that led the way down during the pandemic, industrials, financials, and energy, were down today. Not down much. It's just that these sectors had huge runs in the last quarter of last year, continue a little bit into the first week or so of this year, and they're just giving some back while investors start to rotate money out of those winners again and back into the reopening work from home stocks. Let's talk about froth, okay? Let me stop the share screen for a second. All right, so we're going to talk about froth, and one of the things that we need to talk about is GameStop. The Wall Street graveyard is it's make sure the mic is close enough to my face. The Wall Street graveyard is littered with people calling a top in the stock market ever since the Great Recession ended last 2009, right? And every time the market goes up, there's a boogeyman around every corner. Whenever something a little scary pops or happens, whenever stocks go up, people say, "Oh, it's a bubble." Stocks are in a bubble. Stocks are not in a bubble just because they go up. There's a lot of things to consider in terms of interest rates, conditions. There are things to consider such as investor psychology. There are so many things to consider. All right. By the way, just real quick, I want to welcome Ed. Ed is out there. Ed Cologne says, "Boom, ba-boom." Thank you very much. Hey, you know what? It's nice to get a boom during the live stream. And if anyone else is out there, hit me up with the questions. Hit me up with the words of wisdom, encouragement. What are your thoughts? You've got to have a question. Right, so we're not necessarily there are people who always think we're in a bubble every time stocks go up. The point is, if you're in stocks, you're in stocks for them to go higher. If you get out of stocks every time they go higher, then what's the point of being an investor? That's the whole point. The thing that we should all know is, though, we won't know if we're in a bubble until after the fact. Now, we could be in a bubble right now. We could. And I could give you so many reasons and indicators and stats that say we are definitely in a bubble or highly valued market, very highly valued market. But I can also give you lots of stats, figures, and facts that say no, we're not in a bubble, and this could continue on for a long time. So I don't think it's really even a relevant discussion, bubble or not. I would say if you have a long time ahead of you for investing, then I don't think it really matters so much if we're in a bubble or not. I don't think that's really relevant. Now, if you're somebody who's got a financial goal coming up over the next few years, and you can't afford to see your investments have it take a significant drop and possibly not be what they're valued today when your goal comes up, then that's a different case. That's a matter of personal finance, and that's what should guide you about whether or not you are in the market or not, or how much you're invested in stocks versus cash and fixed income. Those are the things that should guide you. If you're someone who has a retirement coming up and you've got all your money in stocks and you're trading like crazy and you're just making all this money, I'm happy for you. But if you're in over your head and we hit a bubble that pops and you lose a significant 30, 40, 50% drop in the value of your portfolio, would that impact your lifestyle? Would that impact your ability to live the way you're living? Would you be able to stay in the current situation you're in, like your home, your country club, all these things, right? We have to take a look at that. And that's what should guide you, not necessarily if we're in a bubble or not. If you're 30 years old, a bubble would be your friend, believe it or not, because you'd be investing cheap. All those people who started investing in 2006, 2007 and kept investing in their 401k plan, for example, in 2008, 2009, and even up to 2020 when the market went down, think about how much money you've made because you kept investing. So this is why I always say, trust the process. Are you a process-driven or results-invested? Are you process-driven or results-driven? If you're results-driven, you're looking for investments that could pop right now. You're looking for the next GameStop. You're looking for the next Bitcoin. You're looking for the next stock that could for the next Tesla. So maybe you're all over NEO now, right? You're the Chinese electric car company. It's partially owned by Warren Buffett. So maybe that's what you're going to look for because you're trying to push your profits. Sorry about that plosive right there. You're trying to push your profits. You're trying to make your portfolio work now. as opposed to somebody who is, process driven. So you're results driven. Now you're process driven. Trust the process and surrender the outcome. Invest monthly. It's okay to have a combination of, your solid, steadier investments and pick up stocks like a core satellite portfolio. That's okay. So you have your core portfolio of your asset allocation mix, but you want to add some individual situations around that. I'm not saying there's anything wrong with it. It depends on your situation. But if you trust the process, then you'll surrender the outcome, because you'll say, I'll keep investing over the next 20, 30 years. I'm going to give you an example of this. I have a friend of mine who's also a client of mine. And, he's invested, and we managed to move his portfolio to about a 60-40 split, stock 60%, 40% bonds and cash. But his portfolio has done well, and it's done better than he would have expected. We got through the big dip, the market crash, almost a year ago. I'm so glad that we moved out of individual stocks ahead of that, and that we went into an ETF model that was really more suited for him. I didn't move him into ETFs and out of individual stocks to make his portfolio more conservative, because I knew about COVID and this, the market was going to plunge. It's just that he and his wife were a certain time ahead of retirement, and it was time to make that position. In other words, his and his wife's personal finance made the decision for us. I was just alert to it. It was literally on my calendar to the day when we were going to make that move, because I already mapped out their future. I basically know what your future is going to be like. Not specifically like what you're going to have for dinner next week. I mean that I know what life stages are coming up based on when you're going to retire, when a big life cycle event happens. So I know about these, and I plan accordingly with a calendar specifically for each client. And that's a great thing to do. And this way we know the personal finance is guiding us. But he spoke to me recently about, hey, maybe we should take some money out, because, taxes are going to go up. By the way, there's no evidence at all that says if tax rates go up that the stock market goes down. We went over that last week. I wrote quite a bit about it. If you're interested in hearing about that, definitely let me know, and I'll send you the write-up I did and the evidence that I have for that. So, but he's thinking maybe we should reduce stocks or get even more conservative. And I'm thinking, you're about 66, you're 66, and you've got longevity on both sides of your family. You could go on another 20 years. And if you took all your money, divided it by 20 over the next 20 years, and just spent that money, pay taxes and your IRA distributions, and then take into account inflation, you're going to be living not as well as you think in about 15 years because of inflation and because of taxes. And it behooves you to keep invested in the market, because people are living longer, and your pensions are covering your monthly nut anyway, with a little extra room too. So my advice in that case is not to get more conservative, but they're thinking in terms of more like an emotional thing. Like, if rates go up, the market goes down, and they have some trepidation about that. All right. So that's what that is about. So if you're out there, you have any questions about any of the things we're talking about, let me know. The purple Nurple 91. I love that name. AMC. Are you saying AMC is double B rated? Is that for the bonds? Is that what you're trying to say? I'm not really sure, but thank you so much, the purple Nurple 91. I gotta love that, the purple Nurple. So thank you very much for joining us, and really appreciate you being out there. So let's go back to the share screen. I'm going to wrap a couple of things up. Okay, share screen. Let's first take a look at the GameStop performance of the day. So this is the big story of the day. GameStop closed today at $76.79. Hopefully you can see that on your screen. But if you can't see it, or you're listening to me in the, in your car or something, or during the evening, kind of like a podcast, I should really put my podcast voice on a little better. I know as a podcaster, you're supposed to let, I I know as a podcaster, you're supposed to let the mic do the work, but let me get nice and close to the mic. I'm still trying to work out how I want the audio to be. But let's take a look at this stock. I have to keep scrolling down, but this stock was $2 not that long ago. And then it traded around a little over 10 and it just shot up. But today's high was 159. Do you see that? Can you see that? $2.50, 52 range to 159. I can tell you, having adolescent age children who were major gamers, YouTubers, TikTokers, and they live for this stuff. And we are just a very tech oriented household. We've got technology equipment, computers all over the house. GameStop is like the most irrelevant thing. I mean, when my kids were really little, they used to love to go to GameStop to buy the games, and they buy a toy or they get the T-shirt, the Minecraft T-shirt or the Minecraft sword. No more. Well, my kids are older now, so they're not into that. But nobody buys games anymore at GameStop. It's all digital, unless GameStop has a way of becoming a digital distributor. But you're buying the games now directly from the game publishers. All right, and then so the question is, should you have been in a stock like this? I'm just going to come out and say, I don't recommend companies that I think have a very poor chance of survival. And that's my opinion of GameStop. You could have your own opinion. Now, obviously, the stock is a home run, but what happened is that it was a major short squeeze. So I'll explain short squeeze, and then we'll wrap this up because I've got my notes here, and I feel like I didn't hit on everything I wanted to hit. But GameStop to me is an irrelevant company. And it was a very heavily shorted stock. A short stock means, let's say you instead of buying a stock at 10 and hoping it goes up to, let's say, 10 to 15, you made 50% in your money, you bought 1,000 shares. So $10,000, it goes to 15, you made $5,000, goes to 20, you made $10,000. Congratulations. You doubled your money. So if you shorted it though at 10, you're hoping the stock goes down to 9, to 8, to 5. So it works in the reverse. When you short a stock, you're borrowing the stock from your broker in a margin account. And the bet is you're going to sell it first in reverse. You're going to sell it instead of buy it, and you'll buy it back at a future date because you expect it to be at a lower price. So if you short the stock at 10, you buy it back at 1. That means you bought it at 1, you sold it at 10. The order is reversed, but you made $9. So it's like going from 1 to 10. That's $9 a share. It's a big gain. Now, if you're shorting the stock and it goes from 10 to 15, you're basically margined out to zero. Your broker is going to call you up, your brokerage firm, whether it be Robinhood or anybody else, and they're going to say, you have to put more money into your account, or else we're going to cover the position and get you out of it by buying back the stock. And whatever you owe, and you have to pay the brokerage firm back. They won't even let you get to that low of equity. They'll sell you out way before, because the brokerage firms don't want to take the chance that of losing a lot of money on your trade and not being able to collect on it. If they did that too much, they wouldn't be able to stay in business. So if you short the stock at 10, it goes to 15. You could either put more money into your brokerage account to maintain the short position, or you could, you just want to, buy it. You want to cover the short. It's called, you want to buy the stock at 15 and say, I'll take my loss. I'm done. So every time someone has to buy the stock because they don't want to lose any more money, it goes from 10 to 15 to 20. You remember, you're shorting the stock. So the fact that it's going up is a bad thing. The only way you could get out of the position and stop losing money is to buy it back. And if people start losing money, their threshold of pain is reached, right? Oh, I can't take any more. It's 20. I'm going to buy it back. But if a lot of people do that, they start buying the stock maybe will go to 21 or 22. And it's that buying power that's pushing the stock higher. So now the stock is, let's say, 15. All right, let's stop sharing the screen. Stop screen. Okay. And so what happens is the stock goes to 20. You shorted it at 10, so now you have to buy it back at 20. So that's like buying it at 20 and selling it at 10. You lost a lot of money, but when you're shorting it, you're losing double the amount. It's not like just losing half your money. You've lost all your money because presumably you're shorting on margin. So let me give you what happens here is I'm trying to take something a little bit esoteric, and it took me a while to get this the first time I ever heard this. So I'm not trying to say that you can't get this. I just want to make sure that I explain it right. The higher the stock goes, the more short sellers have to pay to cover their position, to close it out and buy it back. And there were so many people short the stock, and they have to keep buying the stock, that they're creating what's called a short squeeze. They're massive buying power because of the short, because they're covering the short covering. They have to keep buying the stock and buy the stock. And no matter what price the stock goes to, okay. And so with the short squeeze, no matter what price the stock goes to, these people are losing so much money. They're getting so many margin calls from their brokerage firm that they just have to buy the stock. And the more of the stock they buy, the more it goes up, creating more pressure on the other people who are short the stock. And it just puts so much pressure on more and more people the higher it goes. And people said, I'm not going to cover my short. I'm sticking to the short. I know the company should be lower. The stock should be lower. And the company, I think, is not relevant. That's what they're saying to themselves. But then the stock goes to 50 and 100. And they're like, I can't take it anymore. I owe my brokerage firm like $100,000 just to get out of the position. And so they have to cover. And the covering goes on and on and on. The buying power goes on and on. And that's what sends a stock so quickly into this hyperbolic move, this rocket ship ride from like 50 to 100 to 150 in no time flat. And finally, when the shorts are done covering, there's no more buying power in the stock. And then the stock finally goes back down, and the short sellers would have been right to stick with it, but they couldn't take the pain of losing all that money on the way up. And they maybe didn't want to pony up more money to their brokerage firm to make up for the margin calls. Because if you're going into negative equity every time the stock goes up, you have to keep putting equity, new money into your brokerage account. And if you don't put money into your brokerage account, the brokerage firm will then cover that short for you by buying the stock in your account. And so they'll create the buying power. So if you do nothing, you're creating buying power because you're going to be stopped. You're going to be covered in your short position, whether if you like it or not, if you do nothing. So that's what a short squeeze is all about. That's what happened. Presumably, that's what happened with GameStop. And it's a very speculative thing to be in. And there are a lot of stocks with big short interest that investors are now looking at to create short squeezes. Bed Bath & Beyond is a name that comes to mind that's been talked about in the media as well. So that's it for today. I hope this helps. It's a little esoteric. If you have any questions, you let me know. And the purple nurple, okay. I hope I hit a chord there, the right chord. I'm going to end this broadcast, and I'll see you tomorrow. Thank you.